Some people think that USDD is
an ultra-conservative, over-collateralized stablecoin, not some risky algo stable.
while others think it is a Ponzi scheme. First, it were pretty clear it was obviously a Ponzi scheme, as they started off using the exact same model like the collapsed Terra Luna ecosystem did. But now they made some important changes and it's time to look at USDD again. If it is not a Ponzi scheme anymore, it could be a very attractive investment now, offering 30% annual returns. Hello and welcome to Finance with Axel. If you watch my videos regularly, you know that I made a video about USDD once before, but it is now outdated because they changed their model in the meantime. So let's look into USDD again, shall we? Before we start, keep in mind that I am only producing very high quality educational and entertainment content. This is no financial advice. USDD is a stablecoin soft-pegged one-to-one to the US dollar. In order to mint 1 USD, Tron worth 1 US dollar needs to be burned. Currently, only whitelisted organizations can do so. Later, this mechanism should also be made available to the community. USDD moved away from being a one-to-one copy of Terra Luna. Now they want you to believe that they are a boring, fully collateralized stablecoin. More secure than every other stablecoin, as they are the only one being over-collateralized by more than 300%. If this is actually true and they, on top of that, also offer a 30% yield, it should be a no-brainer to invest, getting a safe, super secure, unbeatable yield in the bear market. Let's start by looking into the provided collateral. The current circulating supply is about 723 million USDD token, while they got 2.247 billion in total collateral. This would actually mean that more than 300% over collateralization is true. Let's dive deeper and look into the more detailed breakdown. Two things immediately jump out at you. First, if you open the burning contract, there is far less than the stated $723 million in Tron. Instead, it is just 584 million. Second, why the heck are burned Tron, which are used to mint USDD, counted to the collateral? This does not make any sense at all. This means either that the tokens are not actually burned and the Tron DAO is still having access to the supposedly burned tokens, which I can neither deny nor confirm as I cannot read code, but I would be very happy if a blockchain developer could take a look at whether the so-called burn contract really does what it's supposed to do. If someone makes the effort, please tell me the result. Or, which is more likely, the Tron DAO reserve wants to trick us into thinking that they actually have a way higher collateralization than they actually do. Whatever is true, this is a huge red flag in any case. Correcting the collateral ratio by removing the tokens in the burn contract would mean that the actual collateral ratio at the time is only at about 210%, which still would be higher than the collateral every other protocol has. There is also another thing that immediately attracts criticism. Only the USDT and the USDC in the reserves are stable assets that should be used as collateral. Tether has often been in the negative headlines. Whether their stablecoin is as secure as they claim can be doubted. USDC in general is perceived to be much safer. Why not just use USDC as collateral instead? The rest of the collateral consists of unstable assets, which, when you get right down to it, are not suitable to back a stable asset. 2 billion USDD in total have already been authorized, but only 723 million have been issued so far. Any of the whitelisted entities can mint more USDD at any point. At this point, the minimum collateralization is set at 130%, taking into account the balancing trick in which burned Tron are included in the collateralization. The real backing would be way lower than they suggest. Excluding the burned tokens, they could be getting into under collateralization.
Hey, we can just put that into your retirement account and make it go to work for you, and it's gone.
Especially if we also take into account that the volatile part of the collateral could also lose more value in dollar terms. This is especially true as we are in the bear market right now, and this could happen at any point. USDD always likes to be compared with DAI. However, the comparison is flawed because in the case of DAI, as soon as a minimum threshold is reached, liquidations are initiated so that bad debt can never occur. USDD does not have such a mechanism, and according to the documents provided, such a security mechanism is not planned either. The whole architecture of USDD has many weaknesses and does not seem well thought out at all. First, they started using the exact Terra Luna model, which led to a debt spiral in the UST Luna case and lost investors billions. As they got more and more criticism, they made some changes. Now they are marketing themselves as super safe, over-collateralized stablecoin. At the moment, it is true that they got more than sufficient backing. What makes no sense at all is, why do they still need Tron to be burned to mint USDD when you are aiming to be collateralized from now on anyways? The burning mechanism is obsolete. Additionally, there is currently no correction mechanism should the price of USDD fall below $1. In theory, USDD should then be burned and Tron minted, but this is not possible at the moment, not even for the few institutions initially responsible for the issuance. The price can only be adjusted if USDD trades above $1, then they could just mint more to get back to the one-to-one peg with the USD. As more supply means falling prices. Reducing supply is currently not possible, as already described. This is the reason why USDD is trading below $1 all the time. According to the white paper, the mechanism to guarantee price stability is also not the collateral, but a stabilization mechanism which was one-to-one copied by Terra Luna. The peg should be restored by burning or minting USDD for Tron. This mechanism works based on arbitrage. Once USDD trades below $1, it can be bought at the market for, let's say, 95 cents and then be burned for $1 worth of Tron. These Tron can then be sold. The arbitrageur would make a profit of 5 cents in this example. This process would then be repeated again and again until the one-to-one peg is re-established. Thereby, the profits continue to decrease until no more arbitrage is possible. And USDD is again traded at $1. USDD are burned and TRX are minted. The supply of USDD goes down, which causes the price to rise, according to the theory of supply and demand. If USDD is traded over $1, for example at $1.05, the arbitrageur can burn TRX worth $1 to mint 1 USDD. He can then sell it on the market and make a profit of 5 cents. If this process is repeated over and over again, the price of USDD will fall, Tron will be burned, and the supply of USDD will expand. The peg will be re-established again at some point. Unfortunately, this mechanism can lead to a death spiral, as we painfully learned in the case of Terra Luna. Actually, it is no longer necessary to continue using this mechanism since USDD now wants to be an over-collateralized stablecoin. A stabilization mechanism is unnecessary, since collateral is deposited that is worth more than the issued coins. In order to this statement to be true and to actually compare with DAI, there would have to be a security mechanism in place to ensure that backing is guaranteed at all times. For example, there could be liquidations if the collateral falls below a certain level, and or USDD holders would have to have the possibility to exchange the held USDD for USDT or USDC at any time. Unfortunately, they are instead sticking with the old mechanism that has been proven not to work. Even the mechanism presented in the white paper is not yet built in, since so far only the minting of USDD is possible, but not the burning. In summary, it can be said that two systems have been combined that do not belong together. The system was not thought through to the end, and the mechanism does not work in its current form. As soon as new USDDs are added, which can happen at any point, under-collateralization can also occur given the fact that the Tron DAO calculates the collateral ratio incorrectly. The mechanism presented will never be able to work fully because a dysfunctional fee has been introduced. The fee will lead to new issues. Small price differences cannot be adjusted any more than the fee is active. Arbitrageurs will be charged an additional fee of at least 0.5%. This means that the price difference smaller than the required fee cannot be compensated. Since this is not obvious, I will show this by giving an example. If the fee is set at 2%, an arbitrageur has no incentive to intervene unless the price difference is higher than 2%. If he becomes active before this threshold, he makes a loss, since the fees are higher than his profits from the arbitrage. This obvious design weaknesses mean to me that either the developers have no clue what they are doing, or that they never intended to spend the collateral and that they want to go back to the original model in the end. This alone is enough of a red flag for me not to invest in USDD. However, it gets much worse. We will now look at the promised return of 30% per year. In the old 2 pool, you earn Sun tokens only. The yield is actually way lower than advertised. Your real yield would be way lower because these farming tokens inflate like crazy, dragging the price down too. The Sun token is down 100% according to CoinGecko based on the price history of just 2 years. If you look into the price history of just 1 year, it's down 73%, meaning that the yield you get is way less than advertised. The best strategy would be to always sell immediately once you receive the Sun tokens, as holding would be disastrous. Your rewards would still drop substantially in the course of a year when the issued tokens stay at the rate they are today. Way more interesting is the second option I will show you now, as you will receive almost 17% in the stablecoin USDD this time. Only 8% come in the form of almost worthless farm tokens. This looks like a super attractive investment on first glance. The important question is this yield sustainable though? It turns out it's not. Looking at the daily volume and the fees in SunSwap, if you do the math, it turns out that the pool cannot pay this fee sustainably. If they would pay a sustainable yield, it would have to be many multitudes lower. The question that now arises is, where is this yield coming from and who is paying it? Who is better suited to answer this than the Tron DAO team itself? I asked in their Discord. At first, they claimed that the yield is organic and not artificial inflated, which is obviously untrue. I kept on asking a few more times where it is coming from and who is paying without getting an honest answer. Either the mods of the Discord channel don't know better or they deliberately lie to us. This is another huge red flag. Ponzi schemes usually also behave in such a way, promising high returns without disclosing where the interest is coming from. Obviously, it is not possible to disclose the source because it is not a sustainable income, but a pyramid scheme where no real value is generated. The newcomers pay the old established until the house of cards collapses. The newly discovered red flags are unclear money flows and the fact that the team does not deal with questions transparently, but even lies and presumably deliberately wants to mislead. Another huge red flag is the way above market yield. For everyone who knows anything about economics, it is clear that an annual return of 30% must be accompanied by significant risks. Return comes from risk. The higher the risk, the bigger the expected return must be. There is no such thing as high returns without risk. If someone tells you otherwise, be very careful. On top of that, I found some more inconsistencies which are often also typical for scams or at least bad projects. The white paper is purely written. It does not even have a table of content. On top of that, it's very short and leaves many questions open. It also contains inconsistencies. They want to introduce a fee, a so-called Tobin tax, on the minting and burning of USDD. This Tobin tax is not included in the examples where the stabilization mechanism is explained. The language used both on the website and in the white paper is overly enthusiastic, praising the project to the skies and ignoring or claiming that risks do not exist. Both the website and the white paper play down the risks and pretend that USDD is stable and risk-free. The website states that the yield is risk-free not once but twice. The stabilization mechanism is also deemed without risk in the white paper. On the website, they act as the central bank of all cryptocurrencies, which obviously is extremely misleading too. The USDD representatives in the Discord group act the same way, and critical questions get either ignored or often answered with meaningless quotes from the website or white paper. Often the quote has nothing to do with the question. From a serious project, I expect an objective language and a transparent handling of questions. Both are not present at USDD. Instead, the biased language of an obnoxiously loud street seller who only cares about quick profits is used. Other small things also don't add up. The displayed yield on the website is most of the time incorrect, and the actual one usually is lower than the one displayed. Other things which were mentioned before are that the collateral ratio is clearly calculated wrong, the amount of money in the burning contract is also incorrect and not displaying the actual market value of the Tron tokens. Instead, it displays the value of the Tron tokens when they got sent to the contract. I am also worried about decentralization. Neither the Tron DAO reserve nor the Tron blockchain is decentralized at all, though they state that they are. USDD wants to become decentral in a later stage. Currently, it is insanely central and a few people control the DAO. The issuance is also not decentral at all, as Justin Sun minted almost the entire circulating supply, but more about that later. Tron is not decentral because it relies on a delegated proof-of-stake mechanism in which only 27 super representatives validate blocks and transactions. Before we get to the end of the discussion, we need to talk about Justin Sun first, the man behind both Tron and USDD as well. I already gave you a lot of information about him in my older video about USDD. Check this out if you need more insights into him. Only so much here. He fled multiple countries to get away from prosecution. He is also allegedly involved in insider trading. To put it mildly, he has a dodgy character. But he is good in two things: stealing ideas of other projects and at marketing. The Tron whitepaper was a plagiate and the code was mostly stolen from Ethereum. USDD is originally a copycat of Luna. After this has exploded, they had to do something. So they made the previously presented dumb changes to make this coin appear secure. What are the reasons why Justin Sun created this stablecoin? Two reasons immediately come to mind. First, he also wanted a piece of the algorithmic stablecoin's pie. When he made his decision, it was not yet foreseeable that Terra Luna would collapse a few days later. Second, he is one of the biggest Tron holders. He cannot cash out easily without greatly affecting the price. By minting USDD instead of selling Tron, he has found a supposedly easy way to cash out with no big slippage. On the contrary, he has probably even achieved a positive price effect for himself. Burning Tron reduces the circulating supply and will lead to an even higher price. Supposedly, Justin Sun is the biggest user of its own stablecoin. This was found by Coffeezilla.
Because now that we have what is nearly certainly Justin Sun's wallet, we can now see how much USDD he himself is responsible for minting. And the answer is 683 million tokens. That's right, ladies and gentlemen. The entire sum of tokens they've ever minted is like 723 million, which means that Justin himself has minted 94% of all the tokens in existence.
So the USDD coin is most likely used as a clever way to offload Tron to retail investors on a detour via USDD while not crashing the price or even increasing it. For the whole thing to work, you have to generate demand for USDD. The bait here is the 30% supposedly risk-free yield on a stablecoin. You now know enough to make your own decision whether it is worthwhile to get invested. I personally will never invest 1 penny in Tron, USDD or anything else where Justin Sun has his fingers in the pie. Let me know what you think. Thanks for watching. Don't forget to like and subscribe if you enjoyed this content. Bye until next time.